Hey traders, welcome back to the Com Lucro channel. Here's a truth most courses skip. Two traders can look at the exact same chart at the exact same second, and one of them is operating while the other is just gambling. The difference isn't the indicator on the screen. It's whether they're reading the market structure or reacting to their own emotions. Today, in our Technical Analysis for Day Traders series, we go deep on the framework that separates those two traders, Dow Theory. You'll learn the three types of market movement, how to tell a primary, secondary, and minor trend apart, and how to combine that with moving averages, volume, and multiple timeframes, so your decisions come from the market's direction, not from the impulse to act. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before you open a single chart, start with the habit that separates professionals from amateurs. The pros look at the whole market before they ever look at a single stock. Here's David Paul on exactly that top-down process, the same logic Dow Theory is built on.
In the stock market, I look to find companies that are making money, and I want to find undervalued stocks that are aggressively growing their earnings, that are rising, and I want to be buying into those stocks when the general market is rising. So I scan for stocks that fit those fundamental criteria, that are rising, that are breaking up through new highs, and I want to be very, very careful about the general market. When the general market, the FTSE itself is rising, then everything rises with it. When the FTSE is not rising, then everything pretty much falls with it. So the general market is probably 70% of the exercise. So it is what technicians would call a top-down approach, looking at the market, looking at the sector, looking at the share itself, but I superimpose fundamentals in there as well.
This top-down perspective is one of the cornerstones of Dow Theory. You start with the broader market and narrow the analysis down until you reach the individual asset. Notice the discipline in that order. The reactive trader starts at the stock he already wants to buy and works backward to justify it. The operator starts with the market and lets it decide whether he trades at all. With that mindset set, let's build the foundation. This lesson isn't about handing you a strategy to copy. It's about the structure underneath every strategy, the three types of market movement, and how to tell a primary, secondary, and minor trend apart. Master that, and your timing and decisions improve no matter what system you trade. For the practical parts, we'll use real market examples on TradingView, since it's one of the most popular and accessible charting platforms available today. Just remember that while Dow Theory itself is timeless, different platforms may display price or tools a little differently, so getting familiar with your own platform will help you apply these ideas more effectively. Before the technical mechanics, it's worth asking why a set of ideas from the 1800s still runs modern trading desks. Charles Dow, a 19th century journalist and co-founder of the Wall Street Journal, developed a set of principles for understanding how financial markets behave. Those principles became known as Dow Theory and laid the foundation for modern technical analysis. More than a century later, traders around the world still rely on them to read price movement and market trends. So why does Dow Theory still matter in today's fast-moving markets? Because it gives traders a simple framework for how markets move through trends, recognizing whether the market is in an uptrend, a downtrend, or a period of consolidation. These aren't just historical ideas. They offer practical insight into how trends begin, develop, and eventually end, so traders can make more informed decisions about when to enter and when to exit. For day traders especially, separating trends into primary, secondary, and minor movements makes both the broader direction and the shorter-term opportunities easier to see. Even in a strongly bullish primary trend, a day trader can work the smaller intraday moves while staying aligned with the larger one. And that's the real reason it survives. Markets change, but the trader on the other side of your position hasn't. The same fear, impatience, and urge to chase that moved prices in Dow's newsroom move them now. The operator studies structure precisely because the crowd keeps reacting to emotion. Now to the heart of it. Dow Theory says the market is moving in 3 layers at the same time, and knowing which layer you're standing in is half the battle. According to Dow Theory, the market never moves in a straight line. Instead, every price movement can be understood as one of 3 distinct trends that every trader should recognize. The first is the primary trend. This is the long-term movement that can last for months or even years, defining the overall direction of the market, whether bullish or bearish. Even for day traders, reading the primary trend is essential because it aligns short-term trades with the broader direction and tilts the odds in your favor. The second is the secondary trend. These are medium-term corrections or pullbacks that develop within the primary trend and usually last from several weeks to a few months. Think of them as temporary declines during an uptrend or temporary rallies during a downtrend. Recognizing them helps you improve entries and exits without losing sight of the larger trend. Finally, there's the minor trend. These are the short-term fluctuations that usually last from a few days to a few weeks, and they matter most to day traders. Minor trends are the immediate price action inside both the primary and secondary trends, creating the short-term openings traders use for tactical entries and exits. The gambler lives entirely in that minor trend. Every small wiggle feels like the whole story, so every pullback feels like the end of the world. The operator keeps all 3 layers on the screen, which is exactly what keeps a minor pullback from turning into a panic exit. So how do you actually see these 3 trends on a chart? 2 methods do most of the work. The first method is the use of moving averages. One of the simplest and most effective ways to identify trends is by using moving averages across different time horizons. For primary trends, many traders use the 200-period moving average because it provides a clear picture of the market's long-term direction. For example, when price consistently remains above the 200-period moving average on the daily chart, it usually suggests a strong bullish trend, encouraging traders to look for buying opportunities during pullbacks. To identify secondary trends, traders often switch to a shorter moving average, such as the 50-period moving average, which helps highlight corrections occurring inside the larger trend. Let's say price has been trading above the 200-period moving average, but temporarily pulls back and touches the 50-period moving average. This may indicate a secondary trend, a correction within the broader uptrend, and could present a potential buying opportunity for traders looking to enter at a more favorable price. For minor movements, traders often use the 20-period moving average to track short-term price action and guide intraday decisions. For example, if price repeatedly reacts around the 20-period moving average on a 15-minute chart, it may reveal minor fluctuations or intraday trends that day traders can use for quick tactical trades. By observing how price interacts with these different moving averages, traders can better align their positions with the dominant trend and identify possible turning points. For instance, if price breaks below the 200-period moving average, it may signal that the primary trend is weakening or coming to an end, prompting traders to adjust their approach. Moving averages give you the map. Multiple time frame analysis gives you the depth. Let's see how it sharpens those same 3 trends. In this example, Bitcoin is trading in a downtrend on the daily chart, forming a sequence of lower highs and lower lows. This represents the primary trend. Since our objective is to look for buying opportunities, we first need to identify a change in the characteristics of that downtrend, specifically a breakout above the most recent lower high resistance. When that breakout occurs, it may indicate that the bearish structure is beginning to weaken. At that point, we draw the Fibonacci retracement from the most recent low and monitor how the new bullish movement develops, waiting for price to retrace toward the 50% level. This process helps us identify potential areas for a buy entry while aligning the trade with the first signs of recovery in the primary trend. By focusing on the breakout, the key structural levels, and the Fibonacci retracement, we can prepare for future opportunities as market sentiment begins to shift from bearish to bullish. Once price reaches the 50% Fibonacci retracement of the primary movement identified on the daily chart, we move down to the 4-hour chart, which represents the secondary trend. This time frame helps us identify corrections and consolidations developing inside the emerging primary uptrend. On the 4-hour chart, we mark the main support and resistance levels and draw the downward trend line, giving us a clearer view of the secondary movement and allowing us to refine the analysis. Although the daily chart may now be showing the beginning of a bullish reversal, the 4-hour chart can still reveal a temporary bearish correction or sideways movement within that broader shift. These secondary retracements may provide more favorable prices for entering the market, while keeping the trade aligned with the developing primary trend. After analyzing the 4-hour chart, we move down to the 60-minute chart to identify more precise support and resistance zones. In this case, we are looking for a support area that is visible on both the 4-hour and 60-minute charts as price continues to correct. Once these zones are identified, we wait for price to break above the resistance level on the 60-minute chart, which represents the minor trend. After the breakout, we apply the Fibonacci retracement tool to the 60-minute movement and monitor the correction toward the 50% level. From there, we have two possible ways to enter the trade. The first is a more aggressive entry. This option carries greater risk, but may offer a higher risk-to-reward ratio. We wait for price to reach the 50% retracement and then enter a buy position when the following candle closes back above that level. In this case, the stop loss is placed 1 pip below the 4-hour support, while the first target is set at the 4-hour resistance. The second is a more conservative entry with a lower risk-to-reward ratio. Instead of entering immediately after the reaction at the 50% retracement, we wait for price to regain momentum and break above the 100% Fibonacci level, which corresponds to the previous high on the 60-minute chart. The stop loss remains 1 pip below the 4-hour support, and the target remains the resistance level identified on the 4-hour chart. By using multiple timeframes, we gain a clearer view of how the market is moving and can better align our trades with both the broader direction and the shorter-term price action. In this example, we began with the daily Bitcoin chart to identify the primary downtrend and its main support and resistance levels. We then moved to the 4-hour chart to analyze the secondary correction and waited for price to approach the 50% Fibonacci retracement of the primary movement. Finally, we moved down to the 60-minute chart to identify the minor support and resistance zones and wait for a breakout. After that breakout, we applied Fibonacci to determine the entry, placed the stop loss below the support area, and targeted the resistance identified on the 4-hour chart. In short, combining multiple timeframe analysis with moving averages allows us to align our trades with different levels of the market trend. We begin with the daily chart to evaluate the primary trend, use the 4-hour chart to track the secondary correction, and then refine the entry on the 60-minute chart. When combined with Fibonacci levels, this approach helps us identify more precise entry points, manage risk more effectively, and develop a broader understanding of market dynamics before making a trading decision. Those 3 movements rest on 6 older principles, the 6 tenets Dow left behind. They read as plain observations, but each one is really a rule for staying disciplined when your emotions are arguing the opposite. The first tenet is that the market discounts everything. All available information, economic data, political events, market sentiment, is already reflected in the current price. So instead of trying to predict every external event, traders focus on price action itself, because price is the combined effect of everything market participants already know. That's why price movement is often considered the most reliable indicator of market behavior. The second tenet is that the market moves in trends. Prices don't move randomly. They form recognizable patterns that move up, down, or sideways. Once a trend is established, it tends to continue, which is why so much of technical analysis is built on aligning with the prevailing direction. The third tenet is that the market contains 3 types of trends: primary, secondary, and minor. As we saw, the primary defines the long-term direction. The secondary represents medium-term corrections within it, and the minor reflects short-term fluctuations. And reading how they interact is what lets you align short-term decisions with the broader market. The fourth tenet is that trends should be confirmed by volume. Volume tells you how much conviction is behind a move. Rising volume as price climbs suggests real participation and a trend more likely to continue, while price rising on declining volume is an early warning that the move is losing strength. Watching volume alongside price helps you judge whether a trend is genuinely supported. The fifth tenet is that a trend stays in place until a clear reversal is confirmed. Once a trend is established, assume it continues until the market gives unmistakable evidence that the direction has changed. One of the most common mistakes traders make is trying to call the end of a trend too early. In other words, don't treat every pullback as a reversal. Act only when the market proves the existing trend has truly changed. The sixth tenet is that closing prices matter more than temporary intraday moves. The close is the final balance between buyers and sellers for the period, so it often signals sentiment more reliably than the noise during the session. For day traders who open and close within the same session, intraday action still matters, but how price behaves into the close carries information too. A strong close near the high or low can mean momentum carries into the next session, while a weak or indecisive close can warn that the trend is fading. Even on intraday trades, reading the momentum into the close gives you context and keeps you out of erratic end-of-session moves. Read the six together, and one theme runs through all of them. Every tenet is a break on impulse. Discount the noise, respect the trend, confirm it with volume, wait for the reversal, trust the close. The operator treats these as rules he doesn't get to bend. The gambler treats them as suggestions he can skip when he's excited. Put those tenets in a modern context, and the reason Dow theory endures becomes obvious. Technology and execution have changed enormously, but the basic truth that markets move in recognizable trends still holds. Dow theory helps you filter out short-term noise and focus on the larger structure. And by separating primary, secondary, and minor trends, you can sharpen your timing and see where short-term action fits the bigger picture. Most importantly, it pushes you toward objective decisions. Instead of reacting emotionally to every fluctuation, you wait for clear evidence that a trend has changed. Theory is only worth what you can execute. So here's Dow theory adapted to a live day trading session. Although Dow theory was originally developed for long-term market analysis, its core ideas can also be applied effectively to shorter timeframes. For this example, we will use multiple timeframe analysis, which provides a more complete view of the market than relying on moving averages alone. We will use the 60-minute chart to represent the primary trend, the 15-minute chart for the secondary trend, and the 3-minute chart for the minor trend. This strategy is specifically designed for day traders who intend to close all positions before the end of the trading session. The setup requires price to complete a retracement of at least 50% across all three timeframes: the 60-minute primary trend, the 15-minute secondary trend, and the 3-minute minor trend. After price completes the 50% correction on the 3-minute chart, we wait for the first candle to close above that level before entering a buy position. The same principle can also be applied in reverse for bearish market conditions. Let's begin with the Bitcoin USD chart. On the 60-minute chart, which represents the primary trend in this example, the market is currently moving downward. Our objective is to identify a potential reversal into an uptrend on the 60-minute chart, and then use the 3-minute minor trend to refine the entry. To make the structure easier to visualize, I will draw the descending trend lines and mark the main support and resistance zones on the chart. Once price breaks above the resistance zone, I will begin monitoring the new movement using the Fibonacci retracement tool. As we follow the market with Fibonacci, we can see that price enters a strong uptrend. However, the deepest retracement reaches only 38.2%, while a new support and resistance structure forms on the 60-minute chart. This is an important moment. Although the market moved in the direction I expected, it did not follow the conditions defined by my strategy. That means I should not change my rules because of fear of missing out, or FOMO, nor because of fear, uncertainty, and doubt, commonly known as FUD. Remember, a trader's first responsibility is always to preserve capital. Missing an opportunity is infinitely better than losing money by entering a trade that does not meet your criteria. As the movement continues, a new support and resistance structure is formed. Because of that, the Fibonacci retracement must be adjusted to the new swing low and swing high. The Fibonacci retracement should always be drawn between the most recent swing high and swing low on the time frame you are currently analyzing. Now we can see that price has retraced 50% of the movement, so we move down to the 15-minute chart, which represents the secondary trend. On the 15-minute chart, we identify the trend line and mark the relevant support and resistance levels. Then we apply the same rule and monitor the correction until price reaches the 50% retracement. Once that happens, we move down to the 3-minute chart. As we can see, price has already retraced 50% on the 15-minute chart. So we now repeat the same process on the smaller time frame. On the 3-minute chart, we once again identify the trend line for the current movement and mark the main support and resistance levels. Once price retraces to the 50% level and the following candle closes above it, we enter a buy position. The first target for this trade can be the 161.8% Fibonacci extension of the 15-minute movement, or the next resistance level identified on the 60-minute chart. Choosing the higher timeframe resistance may provide a much larger risk-to-reward ratio, but it may also require more time for the trade to reach the target. To protect the position, one option is to partially close the trade when price reaches the 161.8% extension, and then move the stop loss to break even. As price continues moving higher, the target can be adjusted using the next Fibonacci extension levels, while the stop loss can also be raised to protect the profit already gained. With the method on the table, step back and weigh what Dow Theory does well, and where it can quietly mislead you. Its main benefit is keeping you aligned with the broader market direction. By identifying primary, secondary, and minor trends, you improve timing and reduce risk, especially when hunting pullbacks inside a larger move. It also adds structure to your decisions. Focusing on the dominant trend instead of every short-term flicker leads to more disciplined entries and exits. And its emphasis on volume confirmation adds another layer of context about whether a move is backed by real participation. But it has real limits. The biggest risk is leaning on it too heavily. It can identify trends, but it doesn't account for economic events, breaking news, or shifts in sentiment. So using it without confirmation from candlestick patterns, indicators, or fundamentals can lead to missed or poorly timed trades. Trend identification can also be subjective, especially in volatile markets, where a minor fluctuation gets misread as a full reversal. And volume confirmation can be less reliable in markets shaped by high-frequency trading, where unusual volume doesn't always reflect the true strength of a trend. Notice what the limitation really is. Dow Theory doesn't fail you. Overtrusting any single tool does, and that overtrust is emotional, not technical. The operator uses it as one lens among several. The gambler keeps looking for the one thing that's always right, and pays for the search. For a professional's version of that same caution, here's David Paul on how he layers moving averages, Fibonacci, momentum divergence, and volume to catch a trend losing strength before it turns.
I use that 89 period moving average. I use a lot of Fibonacci, and I use momentum divergence to actually give me a heads up as to when trends are about to change, when a downtrend is about to change to an uptrend, when an uptrend is about to change to a downtrend. It doesn't tell you exactly when it's going to happen. The divergences can drag along for quite a long time, but it gives you a heads up that the trend is starting to move into thin ice. And volume is very useful if you've got accurate volume. Forex market, for example, doesn't the banks will not give out volume numbers. There is stuff called tick volume that you can get, but the actual volume numbers they keep to themselves. The stock market gives out volume numbers, and volume is really useful in the stock market. If you've got a share that's rising on rising volume, that's good. But if you've got a share that's rising on falling volume, not so good. Okay, so volume and volume divergence is a very strong tool indeed.
That's why Dow Theory works best alongside modern tools like moving averages, volume, and momentum indicators. Together, they give stronger confirmation and cut the risk of relying on it alone. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.